Welcome. My name is Robin McLaughlin, and I am the Associate Alumni Director here at Northwood. Thank you for joining us today for our November Alumni webinar with Professor Michael Makovi, who will be presenting what Milton Friedman teaches us about inflation today. Dr. Makovi received his PhD in Agricultural and Applied Economics from Texas Tech University, where he was a graduate research assistant for the Free Market Institute. He joined Northwood in 2020 and was recently selected as Northwood University's inaugural Brescoff Scholar. Thank you, Professor Makovi, for joining us today. If you have any questions during today's webinar, please put them in the Q&A feature. We will have some time at the end of the presentation to answer any questions. With that, I'd like to turn it over to Professor Makovi.
If some of you may have read the chapter on money and inflation in Free Issues. What I'm going to do today is I'm going to talk about some of the background behind what Friedman wrote in that chapter. So kind of what was the academic environment and like the theoretical contributions he made that ultimately resulted in that chapter as you might have written it. And then I'll get to what does that mean for today, what's going on today, and what do we do about inflation today. So the background before Friedman came on the scene. Let's talk about where monetary policy was. So macroeconomics today, as it's known, began with John Maynard Keynes, who published the General Theory of Employment, Interest, and Money in, I think it was 1932. I should have put the year here. It was around the Great Depression. So before John Maynard Keynes, economists had believed in the quantity theory of money, which said that in the long run, increases in the money supply result in higher prices. But then Keynes published his book in the wake of the Great Depression, and he argued that if people had what he called liquidity preference, meaning they hoarded any newly created money rather than spending it, then any new creation of money would just end up like in people's bank account balances, never get spent, and it would therefore not necessarily have any increase on prices. Which interestingly meant that Keynes had no good theory for what did cause inflation. Not an increase in the money supply, well, then what? So the closest Keynes came to a theory of inflation was to have aggregate demand, which is basically demand for all goods collectively, and aggregate supply, which is basically supply of all goods collectively. Well, then shifts in aggregate demand from side to side will lead to a higher or lower price level. So basically, that was Keynesians, therefore, would talk about things like an overheated economy. They'd say, oh, like consumer demand is too high, the economy is overheated, prices are getting too high, we need to cool down the economy by getting people to spend less money. And that's about the closest they came to a theory of inflation. Meanwhile, there was an economist, A.W. Phillips, who in 1958 plotted British unemployment against inflation and discovered a downward sloping curve. So this became called the Phillips Curve. And so Phillips claimed that this showed that as you reduce the rate of inflation, you increase the rate of unemployment. And contrary-wise, if you increase the rate of inflation, you decrease the rate of unemployment. So this was taken by Keynesians to be an exploitable policy trade-off, that maybe inflation is caused by the unemployment rate. So if we want to reduce the unemployment rate, we're going to have to increase the inflation rate. And vice versa, if we increase the inflation rate, we can decrease the unemployment rate. Furthermore, Keynesians argue that in general, any kind of monetary policy tends to be ineffective at achieving any kind of macroeconomic goal, because Keynesians argued that business investment decisions are guided by what he called animal spirits, meaning irrational waves of business optimism and pessimism, not any kind of financial calculation of profit and loss based on things like interest rates. And also, the Keynes argued there was what's called a liquidity trap, or what today is called a zero lower bound, which is if you try to stimulate economic activity with lower interest rates, then once you hit a 0% interest rate, you can't go any lower than that. So there's a limit to how much we could ever stimulate the economy through interest rate policy. So the end result of all this was Keynesians rejected the quantity theory of money, so they argued that inflation is not caused by increases in the money supply. That they said inflation, though, is related to the unemployment rate. And finally, that monetary policy in general is not effective. They compared monetary policy to a string. Like you can pull on a string, but you can't push on it. They argued higher interest rates might lead to less economic activity, but lower interest rates won't lead to more economic activity. The end result is, interestingly, 1 year after the Phillips Curve was published in 1958, two Keynesian economists, Paul Samuelson and Robert Solow, testified to Congress and said, in order to achieve the non-perfectionist goal of high enough output to give us no more than 3% unemployment, the price index might have to rise by as much as 4 to 5% per year. That much price rise would seem to be the necessary cost of high employment and production in the years immediately ahead. So, like as soon as the Phillips curve came out, Keynesians immediately started saying, in order to have low unemployment, we need to have higher inflation. But that policy very quickly broke down. In the 1970s, we got stagflation, which was the combination of simultaneous inflation plus unemployment, which Keynesians had thought was supposed to be impossible, but it happened. And furthermore, if you plot the Phillips curve over a long enough time span, we have 1948 to 2010, there's no relationship between inflation and unemployment. It just looks like a big scatter plot of points all over the place. This graph here was created by my friend Phil Magnus, who calls this the Java cluster. Little joke here, bring me the Wookiee Solo. That's referring to Robert Solow from the previous slide. So basically, at this point, Keynesian theory was in deep trouble because they couldn't explain what caused inflation. They couldn't explain the relationship between inflation and unemployment. Their whole theory was basically breaking down. So then we can enter Milton Friedman. He replied most famously in a 1967 presidential address to the American Economic Association that was published in the American Economic Review in 1968, titled The Role of Monetary Policy, which I give the link here. I think this PDF should be accessible to people who don't have a university library subscription. And he replied with several key ideas. He replied with the quantity theory of money, that in the long run, inflation is caused by the money supply. Called the natural rate of unemployment, which is the idea that in the long run, unemployment rates are determined not by the money supply, but by more structural factors like labor regulation. The long run neutrality of money, which says that in the long run, any amount of money is the same as having any other. It's like inches versus centimeters. It doesn't matter whether you have more money or less money, because in the long run, all prices and wages adjust, and the real cost of everything is the same as it would have been. And finally, he put all of that together in what's called the expectations-Augmented Phillips curve, which is a modification of the Phillips curve, which says there is a trade-off between inflation and unemployment in the short run, but not in the long run. So I'm going to take all of that piece by piece and then show where that takes us today. So Friedman said that in the long run, any increase in the quantity of money will lead to higher prices. Sometimes you'll have heard this said as more money chasing the same number of goods. If we double the money supply, but we don't double the supply of goods and services, all that means is that every good and service costs twice as much as before. So Friedman said in 1970 in the Counter-Revolution in Monetary Theory that inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. Now, this is not to deny that prices can be affected by negative supply shocks. So, for example, something like the OPEC oil embargo, all of the COVID supply chain problems we've had, right? There was the Evergreen ship stuck in the Suez Canal. Clearly, events like that do affect prices. But if you're trying to explain a persistent, ongoing, continuous inflation, you can't explain that by a one-time supply shock that gets resolved. So, for example, if COVID were the cause of the current inflation, we would have expected inflation to have been worst in 2020 when COVID was the worst, and then we would expect prices to be falling back down today to what they had been in 2019. But that's not what we're seeing. In fact, what we've seen is that inflation became the highest in 2021 after COVID was already mostly over, and prices keep on increasing today. They show no sign of returning back to the 2019 level. And if you read what the Federal Reserve is saying, the Federal Reserve is merely trying to slow the rate of increase in prices. The Federal Reserve isn't even trying to return prices back to the 2019 level. But if everything is because of supply shocks, the Federal Reserve wouldn't even have to do anything. Prices would just return back to the 2019 level on their own as soon as we solve the supply problem. So we can see a bit of that here. The top graph is the rate of change in the gross domestic product implicit price deflator, which is basically a price index that uses all goods and services. So it's similar to the consumer price index, except it also uses producer goods as well. So this is the rate of increase. You can see the gray bar is basically the COVID period. You can actually see that during COVID, we actually had a negative price increase, meaning we actually had some deflation during COVID. And it was after COVID ended that the rate of inflation started increasing. You can see that today it's up around 8% or so. And the rate of increase is actually increasing. So we're not only getting continuous inflation, but the rate of inflation has been increasing higher and higher after COVID was already over. You can't really explain that with a supply side problem. The bottom graph is the money supply. There's a few different ways of measuring the money supply. So I have two of them here, M1 and M2. And you can see that both of them increased during COVID, and then they keep on increasing. Now the rate of increase has been slowing down, but they've still been increasing over time since the end of COVID. So that's a much better explanation for what's causing inflation. In the long run, any persistent ongoing price rise is generally only going to be caused by an increase in the money supply. Unless the supply problems are getting worse and worse. I mean, if you live in Ukraine and things keep getting bombed more and more and everything is more and more destroyed, okay, that might make prices rise higher and higher. That's not typically what happens in the US. That was Friedman's first idea. The second is the natural rate of unemployment. And what that says is that in the long run, the rate of unemployment is determined by structural factors such as labor market regulation, not by the money supply. Because any quantity of money is always enough to ensure full employment. If we double the money supply, we double prices, but that means doubling both retail prices and wages. So doubling all prices is what's called a nominal change. It changes the numbers, but it doesn't actually change the economic reality. It's like converting inches to centimeters. Or like imagine if we started, let's say like in the US we report car fuel economy in miles per gallon, but there's other countries that do it in liters per kilometer. Well, it makes no difference whether you measure your fuel economy in liters per kilometer or miles per gallon. in the end, your car is going to go the same amount of distance on the same amount of gas. So ultimately, money is neutral in the long run. More money has no real economic effect. It just changes the numbers we assign to everything. Or it'd be like, imagine if we measured things in cents rather than dollars. Okay, so if we measure things in cents, everything costs 100 times more. But clearly it makes no difference. But monetary policy can have an effect in the short run. And so this is called the expectations-augmented Phillips curve, which says that in the short run, an increase in the money supply will temporarily reduce the unemployment rate. So suppose we have 2% inflation and everyone expects 2% inflation. So we write all of our contracts under the assumption of 2% inflation. All mortgage interest rates, for example, are written under the assumption of 2% inflation. Workers are making wage demands with their employers on the assumption of 2% inflation. And so we all expect that everything will cost 2% more next year. So let's say we all demand 2% pay raises, let's say, every year. And now suppose that suddenly and unexpectedly we get 10% inflation. Well, at first, we don't necessarily realize that it's inflation. Maybe at first, businesses think that there's an increase in consumer demand. Suddenly, consumers are willing to pay more money for everything. And the firm thinks, wow, we're being extra profitable. We're making more money. Let's hire more workers. And then some of those workers get pay raises. And those workers think it's fantastic because they don't necessarily realize yet that inflation is going on. They think they're just getting a pay raise, and they think they're in an economic boom. So at first, everyone might behave as if there is a real economic price increase rather than merely a nominal pricing. And so if we mistake the inflation for an economic boom, we might temporarily get higher economic output with reduced unemployment. But eventually we all realize the inflation for what it is. We realize that it's not an economic boom, that it's really just inflation. So let's say workers had gotten 8% pay raises, and now they realize there's 10% inflation, and so they realize they actually got a pay cut. And maybe businesses realize that they didn't update their depreciation expenses. So they thought that all the extra revenue they were making was pure profit, but now they realize it's not just that revenue is up 10%, it's that also costs of production are up 10%. And they should have increased their depreciation expense by 10%, but they didn't. So now we realize that what we thought was profit and pay increase actually wasn't, and then we might get a temporary economic recession as everyone tries to adjust to the new reality. But in the long run, we all come to accept the 10% inflation for what it is. And 10% becomes the new 2%. So let's say if 10% inflation lasted long enough, we might just have workers expecting 10% pay raises every year instead of 2% pay raises every year. And businesses would expect that their revenue will go up by 10% every year, but they would set their depreciation expenses to correspond to that, and we would all be breaking even just as we were under 2% inflation. So what this means is that in the short run, an unexpected inflation can lead to increased economic output and reduced unemployment and create the appearance of an economic boom. But that boom will eventually burst, and at best will go back to normal, or possibly will go into a recession, and then we'll go back to normal. And in the long run, though, any amount of inflation is consistent with the natural rate of unemployment. Because ultimately what reduces the unemployment rate is not inflation itself, it's unexpected inflation. So as soon as the inflation becomes expected and people write their contracts and make their wage demands in correspondence with the inflation, then the inflation ceases to have any real economic effect. Essentially, at that point, inflation becomes similar to an increase in the tax rate. If we go from 2% inflation to 10% inflation, You can imagine it like the IRS announced an 8% tax increase. Obviously, that doesn't make you happy. You don't want to give the IRS 8% more money, but you eventually deal with it. People will just come to accept the fact that every year they have to give more money to the IRS and their standard of living is lower, but we wouldn't have a difference in the rate of unemployment, for example. So what this means is that inflation can be like an addictive drug. If we start at 2% inflation and move to 10%, at first we can get a temporarily increased economic output and reduced unemployment. It feels great. It feels like an economic boom. But then eventually unemployment returns back to normal, but we're still stuck with 10% inflation. 10% inflation becomes the new normal. And so it's like you start taking a drug. At first you feel really great, you get high, but then eventually you go back to normal and you have to keep taking the drug just to feel normal. And then if you try to quit the drug, you go into withdrawal. Well, similarly, if we're at 10% inflation and we try to go back to 2% inflation, the whole problem works in reverse. Suddenly businesses think that they're suffering from an economic recession. Workers don't get the pay raises they expected to get, and we get higher unemployment. So anytime you reduce the rate of reduce the rate of inflation to lower than what people expected, you actually get a recession with high unemployment. And that's where we got stagflation from. Stagflation in the 1970s happened because there had been a very high rate of inflation. And then as soon as the rate of inflation was reduced, that was enough to cause an economic recession, high unemployment. Actually, I think I already said this. I got ahead of myself. I see I'm running a bit short on time, so let me get through a few slides. So I'll briefly say that interest rates show a similar kind of short run, long run distinction. If you increase the rate of inflation, you will temporarily reduce interest rates, just as you temporarily reduce unemployment. But then eventually interest rates will spike back up to what they had been before. So in the long run, then you get stuck with a higher rate of inflation, but the interest rates are no lower than they otherwise would have been. So again, inflation is a lot like a drug. And then let's say if you have a high rate of inflation, and you have normal interest rates, and you try to reduce the rate of inflation, that's going to cause interest rates to spike even higher. So any attempt to end the inflation causes a temporary recession with high unemployment and high interest rates until they return back to normal again in the long run. As I mentioned, kind of saw this in the 1970s. What happened in the 1970s was we would have a lot of periods of very high inflation, but they would also be very erratic. So you can see like the average rate of inflation in the 1970s was about 9.2%, but sometimes it was about 10 or 11%, or even it peaked at one point close to almost 15%, but then at other times it was 5%. So if you constantly have inflation spiking and then spiking and collapsing, then you'll constantly have high unemployment with high interest rates. And that caused the high unemployment despite high inflation. And then in 1979, Paul Volcker, as chairman of the Federal Reserve, realized, okay, inflation is too high. We need to get this under control. So he raised the target federal funds rate from 11.2% up to 20%. So he slowed the rate of increase in the money supply, which caused the interest rate to spike high. That did reduce inflation below 3% by 1983, but unemployment did rise above 10%. So basically, it's like he said, we're addicted to this inflation drug. We got to quit the drug. He quit it cold turkey. Inflation did fall, but the consequence is high unemployment. The U.S. economy had to go through a withdrawal period, but eventually the withdrawal period ended and unemployment went back to normal again. And we also have to think about where this relates with fiscal policy. So the problem we also have is that Congress keeps wanting to spend more money than the federal government takes in tax revenue. And there's only a few things it can do. It can either raise taxes, or it can borrow the money, but borrowing the money just means it needs to raise taxes someday in the future to pay it off. Or we can engage in debt monetization, which is when the Federal Reserve creates new money out of thin air in order to pay for the federal debt. Basically, when Treasury borrows money, it issues a bond. Then if that bond gets sold to the Federal Reserve prints the money out of thin air to pay for the bond. So the Treasury and Congress have been putting pressure on the Federal Reserve to monetize more debt in order to help keep the Treasury interest rates low, so that the federal debt remains serviceable. So the problem there is that in the long run, we can only control inflation if we're also willing to control Congress's spending. If Congress will not reduce the spending, then either it will have to raise taxes or keep on creating money out of thin air. And in the long run, there's not much we can do about that, other than those choices. So, bottom line, Friedman argued that in the long run, there's no benefit from inflation. The only benefit from inflation is a very short-run effect, that it temporarily reduces interest rates and unemployment, but then in the long run, interest rates and unemployment go back to normal, and we're just stuck with the high inflation with no benefit. So it's like a drug. And then when you try to quit the drug, you go through withdrawal. So let's just not start the drug in the first place. He said, ultimately, monetary policy is just as likely to cause a recession as it is to mitigate a recession. He pointed to the fact that, for example, the Great Depression in 1929 began with a contractionary monetary policy when the Federal Reserve reduced the money supply. So Friedman argued that instead we should aim for a stable, predictable policy of growing the money supply at some constant rate without erratic shifts from high inflation to low inflation. It doesn't so much matter what the rate of inflation is, as long as it remains stable and predictable. And of course, a lower rate of inflation is probably better than a higher one. So actually, his influence has been pretty enormous. Basically, the entire economics profession accepts almost everything he said, except for his policy conclusion, which is kind of funny. So all of his theoretical arguments have been accepted. Quantity theory of money, the expectations-Augmented Phillips Curve, the short-run, long-run trade-off. But the Federal Reserve still engages in discretionary monetary policy, where it tries to target particular interest rates to either stimulate or retard the economy. They haven't accepted his policy proposal of a stable, predictable, constant, non-discretionary monetary policy. But that's where we are today. So I think let me stop there and see if there are any questions.
Thank you, Professor Makovi. We got one question so far. What type of assets are a good hedge on inflation?
So first off, I will say that is outside what I study. I'm not don't do finance much. In general, I would say things like, well, I guess it depends on your time span. If you are willing to wait long enough, like if you're not retiring for many, many years and you don't need your money anytime soon, then I would say something like index funds. Index funds tend to track the market. They, on average, make about a 6 to 7% rate of return. They do lose value during recessions. So you don't want to put in an index fund if you need your money at any, for any random emergency. But if you're like planning for your retirement, you're not going to retire for 30 years. It doesn't matter if they lose value during the recession because they're going to make it back eventually. If you need your money sooner, then you want something that doesn't lose its value. So then probably just something like bonds, which don't make a great rate of return, but they're also subject to a lot less volatility. But that, again, I'm not a finance expert, so take that some skepticism.
Another question we have is, how will our current inflation spiral, like drug addiction, abate since it seems government unlikely to cut spending and the Fed is unlikely to stop printing?
So I think what's going to happen probably is we're probably going to keep getting some moderate inflation. Congress is probably going to keep spending more money than it makes in tax revenue. Now, the U.S. is probably not going to go bankrupt. I mean, there are countries that have gone so deep into debt that they just completely defaulted. That's probably not going to happen in the U.S., although I can't promise it won't, but probably not going to happen. The U.S. is probably also not going to go into a hyperinflation. Like there's some countries that have gotten 100,000%, 1,000,000% inflation. Probably not going to happen in the U.S., but I can't promise it won't. We're probably going to keep getting moderate inflation with a moderate increase in the debt, and then we're probably going to have moderate tax increases to pay for the growing debt, and we will probably muddle along in a way that is not ideal, but probably also not disastrous.
All right, one more question. Did Milton Friedman ever comment on our global reserve currency and its effects, the Fed's ability to print with less domestic inflation?
I am almost certain he must have written something along those lines and basically said what that questioner just said. I can't remember him saying that, but that's pretty universally accepted by economists, so I'm almost certain he must have said it somewhere. But yes, the fact that the US dollar is a reserve currency does create extra demand for the dollar, which makes the dollar more valuable, which does help increase the purchasing power of the dollar and reduce the rate of inflation in terms of prices. So yeah, if the US dollar ever stopped being the reserve currency, we would have a fall in the value of the dollar, and the dollar would lose purchasing power and everything would become more expensive. So yeah, I mean, the question is correct, and Friedman probably said that.
And I think that's it for questions. Thank you everyone for joining us today. We will send out the slides and the recording in an email later this afternoon. And we hope that you'll join us next month for our next webinar.